You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome to the Deep Dive. Today, we're really cutting through the noise. Got a global briefing for you.
That's right.
We've synthesized a stack of sources covering, currencies, commodities, trade policy.
And those crucial geopolitical pressure points.
Yeah.
A lot going on.
Exactly. Things dictating global risk appetite right now.
So our mission today really is to give you a clear, well-informed snapshot of this pretty dense environment.
Okay.
The global landscape. I mean, right now it's defined by a pretty steady dollar, but it's running right into some high-impact U.S. data releases. We're also seeing bids in specific commodities, think gold, copper, and then there's just this dense slate of trade actions and security things to watch.
Right. So we're going to try and distill the most critical signals for you, connect the dots across finance, foreign policy.
Yeah, whether those dots start in Washington or Copenhagen or Tehran, it's all connected.
Okay, let's unpack this then. Starting with the currency chessboard. The dollar's had this recent grind higher, but you mentioned the data slate hitting this week. Sounds like that's designed to test its strength.
Oh, it absolutely is, yeah. This period of dollar steadiness is a bit deceiving because markets are really waiting on this heavy calendar of U.S. releases.
Like what specifically?
You've got durable goods, the final Q2 GDP and PCE data, that's key jobless claims, the advanced goods trade balance. I mean, that's a lot.
Right.
If the dollar is going to, break out significantly or pull back hard, it'll likely be driven by those numbers.
And especially that final Q2 PCE.
Yeah.
That's the Fed's preferred inflation measure, right?
Exactly. If that accelerates unexpectedly, well, that directly contradicts the current messaging from the Fed.
Okay.
And forces the market to price in a higher terminal rate. That's the immediate test for the greenback.
And speaking of messaging, the central banks seem to be all over the place right now. Very divergent signals. What's the read on the Fed after that last 25 basis point move?
Well, the Fed is talking very cautiously. We heard Mary Daly framing last week's hike as just insurance, pure insurance.
Insurance, okay.
Yeah. She estimates inflation, if you strip out tariffs, is maybe around the 2.4 to 2.5% area. But at the same time, you had Austin Goolsbee warning specifically against the market, assuming they'll front-load a whole series of rapid rate cuts.
Right. So don't get ahead of yourselves.
Exactly. The key takeaway for you, the listener, is the Fed's moving incrementally. They're basing it on backward-looking data, but they really refuse to commit to a forward path. Very data-dependent.
That caution, it really contrasts sharply with what we're seeing across the Atlantic, doesn't it? Especially between the Eurozone and the UK.
Oh, definitely.
The insight here, I think, for our listener is that these central banks are now operating totally on their own local inflation mandates. And that creates huge FX divergence risk.
That's the perfect summary. Yeah. Look at the euro. It's barely moved. Why? Because Kazimir at the ECB basically said, inflation target met, mandate fulfilled.
So they'll only shift policy if needed.
If absolutely necessary. They're very much in wait-and-see mode. Now, contrast that with the UK.
Right.
BOE policymaker Greene argued policy might need to actively offset supply shocks. She explicitly noted upside inflation risks.
Actively offset. That sounds much more interventionist.
It implies the UK might be facing structural supply challenges that need a potentially much more aggressive policy response than the Eurozone thinks it needs right now. Big difference.
What about the Swiss National Bank? They're often seen as a sort of barometer for European stability.
The S&B held its rate at 0%, emphasized policy is still expansive.
Okay.
And Chair Schlegel gave a crucial technical detail. The bar to go back to negative rates is now higher than for just a normal cut.
Interesting. So they really don't want to go negative again soon.
Seems that way. It's a powerful signal. They also noted tariffs have had a limited impact on Switzerland, which helps insulate the franc a bit.
Okay, let's hop over to Asia quickly. Before this U.S. data storm hits, how are central banks there trying to maybe set their own anchors?
They are managing expectations very closely. Bank of Japan minutes showed some officials supporting a hike when possible, noting policy is still below neutral.
But the majority still wants patience.
Right. But the more actionable signal, I think, came from China. The PBoC, the People's Bank of China, they set the daily USD-CNY fixing tighter than expected, 7.1111.
And setting it tighter means?
For you, the listener, setting it tighter is the PBoC explicitly signaling they want to stem capital outflow, stabilize the yuan before potential U.S. volatility hits. It's a clear management strategy.
So these anchors, set by the PBoC, the SNB, they tell us how money's flowing. But those decisions always spill over into the physical world, don't they?
Always.
Let's see if the real economy gives us a cleaner signal. This is where it gets really interesting. The commodity complex.
Okay. Let's start with crude oil. Despite all the headlines, Russia's energy system issues, Middle East friction, crude is actually pulling back a bit.
Really? Why is that?
Prices are drifting lower. Seems to be due to a softer, sort of overarching risk tone globally, and just a lack of fresh, immediate supply shocks hitting the headlines right now.
Okay, so if crude is easing slightly, maybe suggesting some market confidence in supply, but gold is marching higher. Towards, what, $300 to $800 an ounce?
Yeah, gold's climbing again.
Is that just technical quarter-end stuff, or is there real risk-off conviction for Q4 behind it?
I think it's conviction-based, driven by that volatility we were just talking about in currencies. Gold's resumed its climb mainly due to two things. Yes, some technical quarter-end positioning, but more importantly, the sheer density and uncertainty around that U.S. data calendar.
Right. Uncertainty drives haven flows.
Exactly. Uncertainty feeds direct risk-off flows into gold. Investors want a haven against conflicting central bank signals and unpredictable policy outcomes.
And then you've got copper. Dr. Copper, the bellwether for global growth. It's extending its strength.
It is, yeah.
What's the fundamental driver there? Supply concerns.
Copper's strength is supported by general lingering supply worries, yes. But the crucial specific detail, the real policy signal, is coming straight out of Beijing.
Oh, what are they doing?
They are actively studying measures to strengthen regulation on copper smelting production capacity.
Smelting capacity, okay.
This isn't just talk.
Yeah.
This regulatory action, it confirms the market's underlying belief that there's fundamental structural tightness heading into year-end.
So if the world's biggest consumer is looking to regulate capacity,
they're basically confirming the supply picture is constrained. Big signal for copper bulls.
that shifts us neatly then. From money and commodities to the rules governing their flow. Trade and tariff headlines are thick right now. What's the immediate action out of Washington on the industrial policy front?
Washington's moving fast on several fronts. The most immediate action expected is the White House signing executive orders, possibly this afternoon.
Okay.
Reporting suggests this includes the long-awaited TikTok agreement. Sources indicate China and all the relevant parties have actually agreed to the terms.
Wow, okay. That's significant for data and digital trade.
Huge. But there's a crucial nuance here about the high-level contact happening at the same time, separate from the EO.
Go on.
Absolutely. While that TikTok order is expected, there's a non-principal Chinese delegation in Washington right now.
Okay, for what?
Staff-level technical discussions on trade and the economy at Treasury. But we have to be super clear here. This is explicitly not a negotiation round on tariffs or big policy stuff.
Right.
And TikTok is not on their agenda. It's technical engagement, just keeping communication lines open, separate from the policy hammers being swung elsewhere.
Speaking of policy hammers, Washington's also broadening its industrial policy reviews, right?
Yeah.
Beyond digital media and tariffs, they've opened a new Section 232 probe.
That's right. Using national security justification for potential tariffs, it's a big move.
On what this time?
Imports of robotics, machinery, and medical devices.
Wow. Yeah.
This signals an expanding definition of what the U.S. considers a security risk to its domestic industrial capability.
And not just probes, right? There's talk about rare earths, too.
Yes. The U.S. is discussing broader measures with the G7 and the EU to counter rare earth price dumping.
Options like tariffs or price floors.
Both are on the table, apparently. Tariffs or specific price floors to try and stabilize those critical mineral supply chains.
Okay. Beyond that industrial policy push, we've seen some important financial diplomacy lately, too.
We have. Treasury Secretary Bessent underscored the strong U.S.-South Korea alliance, and discussions were specifically noted on an FX swap line.
An FX swap. That's not just standard diplomacy, is it?
No, it's more direct. An FX swap basically offers a financial safety net to Seoul. It improves stability during, say, global crunch times by ensuring they have access to dollar liquidity if needed.
Got it. and other diplomatic moves.
Planning continues for that high-profile presidential visit to Japan late October. And in Brussels, Commission President von der Leyen described her exchange with China's Premier Li Qiang as good and frank, welcoming engagement despite all the trade friction we just talked about.
Right. There was also one warning that came out about air travel. Ties back to existing rules.
Correct. The U.S. warned European countries against restricting air travel, said it would violate existing bilateral agreements.
So a subtle reminder.
Subtle but firm. Basically saying, even while we're negotiating new trade rules, the existing global agreements have to be respected, or trade flow in this case, travel risks immediate disruption.
Okay. We've hit money, commodities, trade rules. Let's wrap up by looking at the immediate flashpoints in global security. We are seeing some concerning headlines filter in, especially Northern Europe.
Yeah, that's where that sort of hybrid risk becomes physical. Danish police reported unidentified drones over 4 airports.
Unidentified drones?
Yes, briefly forced the closure of Aalborg Airport. Officials also noted similar events happened at military facilities.
Any link established?
No direct link established yet, but the significance is the immediate spillover of these hybrid warfare tactics into civilian critical infrastructure.
Right.
This could easily prompt officials there to raise the national emergency posture. And that impacts everything from insurance premiums to energy risk assessments in the whole region.
And this kind of thing, it feeds directly into that wider political unease about transatlantic reliability, right?
Yeah.
On issues like Ukraine policy.
It absolutely does. European officials are voicing genuine uneasiness about transatlantic reliability on Ukraine right now.
They're worried.
They're wary that shifting rhetoric out of the U.S. could maybe reframe responsibility if Kyiv falters. And that sentiment, it's now filtering directly into how they calculate future energy and defense risk.
So when allies start worrying about reliability,
It fundamentally changes their procurement decisions, their strategic investments, big long-term impact.
okay, shifting to the Middle East front, the 3 big European powers, the E3, they've moved on Iran sanctions.
Yes. Leaders of France, Germany, and the UK, they've moved to activate the UN snapback mechanism, trying to reimpose sanctions on Iran.
The message being,
Stressing Tehran must never get a nuclear weapon, urging cooperation with inspectors. Standard lines, but activating snapback is a serious step.
but is that the whole picture?
Well, it's vital to remember this high-stakes diplomatic pressure is happening alongside parallel U.S. outreach. Indications are there's still continued contact with Iran.
So a dual track, pressure and contact.
Exactly. A very difficult balancing act. Maximum deterrence while trying to keep some communication channel open.
Finally, we have to touch on a domestic U.S. headline, but one that markets will track closely for potential global spillover.
Great. This is an administrative step, but it signals domestic risk appetite. The U.S. Budget Office has instructed federal agencies to prepare workforce reduction plans.
In case of what?
In case a government shutdown occurs. Markets track this kind of uncertainty very closely. It impacts the dollar, U.S. growth expectations. It doesn't even matter if a shutdown actually happens. Just the planning generates administrative instability.
Okay, that was a really packed briefing. Let's try and synthesize the critical signals we just tracked.
Yeah, let's recap. The overall landscape shows a dollar that's steady but really vulnerable to that incoming high-impact data. Gold and copper are maintaining strong bids. That's driven by both the uncertainty we discussed and, for copper especially, fundamental tightness confirmed by Beijing's regulatory plans.
And globally.
Globally, you've got this packed schedule of pretty aggressive trade actions running in parallel with some high-stakes, very nuanced diplomatic outreach.
So the key tension for you to watch as a listener is this simultaneous push, right? Specific industrial policy goals like that Section 232 probe on robotics, the rare earth price floor talks.
Right, very targeted actions.
Running alongside high-stakes diplomatic contact with major trading partners like China and adversaries like Iran. The world's trying to protect its industries, assert national security.
While simultaneously trying to keep the lines of communication and commerce open, it's a tricky balance.
But let's leave you with one final thought to chew on. We know the market watches global policy constantly, but that administrative step we mentioned.
The U.S. Budget Office telling agencies to prep for shutdown job cuts.
Exactly. That really stands out. Consider the effect of just administrative uncertainty on global risk appetite. If this step is already being tracked for spillover into growth expectations, we have to ask, does the mere preparation for a shutdown maybe stop CEOs from making hiring decisions or capital investment decisions today?
Thereby slowing growth. feeding back into potential dollar weakness.
Even if Congress manages to avoid the actual crisis next month, does that administrative friction have a real-time financial impact all its own? Something to think about.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.